Hello everyone, and welcome to the third of 3 charting analysis videos today. This video will focus on indices. The previous 2 are out already, one covering 8 FX currency pairs, another half a dozen commodity charts, and obviously now wrapping things up with a few indices, the DAX, the Dow and the S&P. So without further ado, let's crack on with these. We're starting with the S&P. A few key points which I want to point out here, a couple which I've pointed out in previous videos, but I'll just reiterate. One, we do have this very important zone here between around 1807 and 1828. Now I should highlight we have already had the break of the ascending trend line, which I've highlighted on previous videos. So this is really the first indication that we are seeing potentially a broader correction if we haven't already seen it. But this ascending trend line, it's not perfect because it does skip out this period here, but the reason why I keep it on my chart is because you can see there's a number of points post this consolidation period that the chart does respond to that trend line. Most recently, when we saw a correction higher back towards 1940, 1943, and then it ran into the trend line, and we got that confirmation of the break and a continuation of the move lower. Now, we've had the break of that, and that would suggest that maybe there is more downside to come. We've got the 200-week simple moving average just below these levels as well. But the fact that we've just got these lows from over the course of the past 18 months or so, April 2014 onwards, I think this is just such an important zone. If we see a break below here, we could be looking at a move back towards these 1735 levels, prior support, prior resistance. Of course, as I've just highlighted, the 200-week simple moving average may provide some support on the way. If we're looking back at previously, it didn't provide that much support here. We did see some resistance being found on this level. You can see maybe a bit of resistance, maybe not the most reliable, as you can see from the back testing. So it'll be interesting to see what kind of response we would get to it on this occasion. But this, I think, is far more important. It's going to be this zone here, 1807 to 1828. Now, what I find interesting here is the last 2 times we've had these levels tested, we've seen a lot of buying pressure. Really, the buyers coming in and really driving these prices higher. Here we had a nice hammer candle. Green hammer candle. Now with this didn't last, we didn't get too much of a rebound off the back of this. We saw some more selling around these 1943s, but we come back to these levels again, and once again we drove these prices higher, and we've got another hammer candle here. Now this one closed unfortunately the week below the opening level, so not quite as strong as you'd see on this occasion, but we are seeing a bit more buying today. Now you can see on the chart here, I've highlighted a possible resistance level, just because on a few occasions over the past 12 months or so, over the past couple of years, we have found resistance at these levels, support and resistance at this level. So we're looking at around this 1890, 1900 level, nice round number as well. And we are running into resistance at this stage. But what I find very interesting here is how it's going to react in the next week or two. I think is going to be very key. To give you a couple of scenarios, for example, if we run into resistance here and then move back to the downside, we're seeing these lower highs. Now that would indicate that we are seeing the market is still bearish, and we're potentially going to see a break to the downside. Alternatively, we move back towards these 1943s, and we've got this really nice double bottom formation, potentially highlighting a bottom, of course, in this trend. A break of the neckline, of course, would be very bullish, and given the size of this double bottom formation from 1805, say, to 1945, that could indicate around a 140-point move higher, based on what we can often see and what the textbooks say about these double bottoms, which could potentially take us back to around 2085. So we're literally looking right back up at these highs which we were trading at towards the end of 2015, really eradicating all of the losses which we've seen so far this year. So really the next couple of weeks could be really crucial for the S&P, and we could get confirmation that we're going to see a much broader decline, or that we're actually bottoming out. So I think this could be an interesting chart to keep an eye on. The next is the Dow, and we're seeing a broadly similar message. The only difference here, I think, in the Dow, which compared to the S&P, is again we've got this ascending trend line. As with the S&P, this trend line does go back to financial crisis lows. The difference being that we don't have that little interruption in between. This is just a pure trend line. The first touch being the financial crisis lows, and then a couple of touches more recently when we've been trading down at these levels. We've also got the 200-week simple moving average, which has provided support along the way. You can see again back in August and more recently. But we haven't had a close below this ascending trend line, which is quite interesting. And what we've effectively got now is we've had this triangle. Now we broke below the triangle, which was something I pointed out in the previous video, which I suggested may be quite a bearish signal and suggest we're going to see more pressure down to these previous lows and also the August lows as well. Instead, we've kind of seen some buying front running these lows around these 15,475 levels, and we've driven ourselves back inside the triangle. So that effectively removes the triangle as known resistance. Now we'll be keeping an eye on this as this triangle as legitimate for setup. So we're effectively just not paying attention to that anymore now that we've traded back inside. But once again, we still haven't seen a weekly close below the trend line. Now it's the next level I'm really paying attention to is going to be these 360, 365s. Again, we've got this little trend line here, so a break of this trend line would potentially indicate a more bullish bias in the markets. And again, we've got this 16450 neckline of a double bottom. So again, of course, it's going to be very similar to the S&P 500. We've got a nice little double bottom here with the size of the double bottom potentially being 15,475 to 16,450. So you're looking at around 1,000 points there. So you're potentially looking back towards 17,450, which again you're looking right back, really eliminating all of the 2016 decline. Should we? Of course, I should say possibly. This isn't an exact science, and it's not guaranteed by any stretch of the imagination. But based on the size of the double bottom, projecting the move higher, if we do see a break above the neckline, that could be potentially very bullish for the Dow. We are seeing we may see some consolidation in the coming days, though. It all really depends on how we react to this trend line. At the moment, it still looks in consolidation, given that we're having the lower highs and the higher lows, but a break could indicate far more bullish period to come. Wrap things up now with the DAX, and we have seen a rebound off these lows. Of course, we have seen much broader declines in the DAX. We've seen a break of the ascending trend line. Now this ascending trend line covers the period from the Eurozone debt crisis lows back in 2010 rather than the financial crisis lows. And while we are seeing a little bit of upside in the DAX at this stage, I think the major support really we're looking at here is around these 8530 to 8330. Again, that's 200-point range, of course, but this is just such a clear zone of support, having previously been resistance. We are seeing a bit of a rebound at the moment, and I think the next key test really for it's going to be these 9310s. We've got the 21-day simple moving average, which has provided some resistance during this decline. More importantly, though, we've got this previous support, which was support on a number of occasions, which we actually broke below recently. What makes it so important is if we see a break back above here, it could be an early indication that the market is reversing. But on the other hand, if we see a rebound off of these levels and lower, it'd be confirmation of the initial break below, which would actually be quite bearish. If we move down to the 4-hour chart, we could actually be seeing a double bottom actually having been double bottom neckline having already been broken, which may be an indication that it's going to be the former that we're going to see rather than a rebound and lower. The fact that we've had the break of this double bottom may suggest we're actually going to see a bigger drive higher, nice little bottoming formation here. Of course, this is shorter term than the bottoming formations we were highlighting on the Dow and the S&P, but still a bottoming formation nonetheless. So that's 8700 through to 90, around these 91s. So we're looking at around 400, maybe a move back towards the 95s. Which coincides roughly with the support and resistance levels as well. But more importantly, a breakthrough there would mean a break back through that important resistance which I've just highlighted. So again, potentially an interesting one for the coming weeks. For more in-depth news and analysis, check out OANDA MarketPulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.